Welcome to another deep dive. Today, we're plunging into, well, what can be a pretty challenging area, financial reporting.
It definitely can be.
Our goal here is really to turn those complex, maybe even dry technical bits into insights you can actually use, whether you're making business decisions, looking at investments, or just curious, really.
Yeah, understanding how companies report their performance is fundamental.
And our source today is a bit different, maybe. It's an examiner's report from a recent financial reporting exam.
Right.
Now, don't switch off thinking this is just for students. Trust me, these reports are like a gold mine. They show exactly why certain accounting ideas trip people up again and again.
They really do. They reveal the common sticking points, the blind spots.
So what we want to do is pull out the key nuggets from this report.
Exactly. We'll look at common mistakes, sure, but also where people did well and the advice the examiners gave. Because, understanding where things often go wrong is a great way to solidify your own understanding.
Yeah, it really helps cement those core financial concepts. Okay, let's unpack this then. We'll go through some basic objective questions first, then some case studies, and finally, the big constructed response questions.
Sounds good. It's a journey from foundations to application.
So let's kick off with those foundational principles, the objective test questions, designed to check core knowledge. But some common issues popped up even here.
They did. A really good example was around IFRS 16 leases. You know how companies account for leases.
Right. Cars, laptops, buildings, all that stuff.
Exactly. And this question honed in on the recognition exemptions, the optionality trap, as we might call it.
Ah, okay. So the exemptions for short-term leases.
Yeah, 12 months or less. And also low-value assets. Think laptops, maybe phones. But crucially, not high-value things like new cars, typically.
Okay, so those exemptions exist. What's the trap?
The trap is that they're optional. You can use them, but you don't have to. A lot of candidates seem to think they were mandatory.
I see. So just because you can just expense that short laptop lease.
It doesn't mean you're required to. You could still choose to put the right-of-use asset and lease liability on the balance sheet if you wanted, following the main rules.
That's a key nuance. It's a choice.
It is, and it affects how the balance sheet looks, right?
Yeah.
Asset-heavy, maybe more debt showing, impacts perception, even if the cash flow is the same eventually.
That's a vital distinction. Okay, moving on from leases. The next area was consolidation, IFRS 10.
Always a favorite area for tricky questions.
This one focused on non-controlling interests, the NCI, and how profits and gains get shared in a group.
Right. So the NCI, the shareholders who own the part of the subsidiary the parent doesn't own,
Yeah.
they get a share of the subsidiary's post-acquisition profit, obviously. But, and this is the key bit, they also get a share of other post-acquisition gains.
Like what kind of gains?
Like a revaluation surplus. If the subsidiary revalues its property upwards after the parent bought it, the NCI is entitled to their share of that uplift too.
Ah, okay. And the common error was?
Forgetting that second part. Just giving NCI a share of the profit, but ignoring their slice of the revaluation surplus.
And that throws off the consolidated figures.
Significantly.
Mm-hmm.
It understates the NCI figure on the balance sheet and also the group's revaluation surplus. It gives a skewed picture.
So for you, the listener, when you look at consolidated accounts, remember the NCI share reflects more than just operating profit.
It reflects their share in the subsidiary's total comprehensive income, basically.
Makes sense. Okay. From specific standards to broader application or ratio analysis. This question involved two competitors in an inflationary economy.
Delugco and Ribamco, I think.
That's them. And their profitability ratios were different, apparently because of their accounting policies for inventory and property.
Yeah, this is a classic, how accounting choices impact the numbers, especially when prices are rising.
So the company with higher profitability, Delugco, why might that be?
Well, two likely reasons based on common policies. First, inventories. If they used FIFO, first in, first out. In an inflationary time, that means the older, cheaper inventory costs hit the cost of sales first. So lower cost of sales, higher gross profit.
Right, compared to, say, weighted average cost.
Exactly. And second, property. If they use the cost model instead of revaluation,
Okay.
their property carrying amount would likely be lower than fair value, meaning a lower depreciation charge hitting the profit and loss. Again, boosting reported profit.
So it really highlights, doesn't it? You have to look behind the ratio.
Absolutely. Understand the accounting choices. Are they using FIFO or AVCO, cost model or revaluation? It drives the numbers. You can't just compare ratios blindly.
It's about the why, not just the what.
Precisely. Guessing gets you nowhere here.
Okay, wrapping up this first section on foundations, the conceptual framework, the bedrock principles.
Yeah, the International Accounting Standards Board's framework. Its purpose often gets misunderstood.
How so?
Well, its main job is to assist standard setters and users in understanding and interpreting IFRS standards. It provides the underlying concepts. But, and this is crucial, it does not override any specific IFRS standard. If a standard says do X, you do X. Even if you think the framework implies Y, the specific standard always wins.
Okay, that's a key hierarchy point. And what about the qualitative characteristics? That relevance and faithful representation are fundamental.
Correct. Those two are the fundamental qualities that make information useful. Everything else builds on that.
And materiality. This is about size, right?
It's about nature or magnitude. Something can be material because it's big in dollar terms or because of its nature, like a related party transaction, even if small. It's about whether it could influence a user's decision.
Got it. And the other characteristics like comparability, verifiability.
Those are enhancing characteristics. They make useful information better, but they aren't the primary requirement, like relevance and faithful representation.
And people mix those up, fundamental versus enhancing.
All the time. It's a really common point of confusion understanding that hierarchy. It really clicks when you realize the framework helps but doesn't rule.
Okay, interesting stuff. So having hit those core ideas, let's move into how they play out in more detailed scenarios, the case studies.
Right, section B. This is where you apply the knowledge more deeply.
And our first case study is Timber Co. They grow trees, harvest them, process wood chips. Sounds agricultural.
It involves IAS 41 agriculture, definitely,
that?
but also IAS 2 inventories and IAS 8 accounting policies.
And the lesson here was about detail.
Absolutely. Even shorter standards like IAS 41 are fully examinable. And the examiner stressed how crucial careful reading of the scenario is. Missing small details like rounding instructions cost candidates marks.
Okay, so let's start with IAS 41 basics, the definitions. What exactly is a biological asset versus agricultural produce?
Good place to start. According to IAS 41, a biological asset is simply a living animal or plant.
So Timber Co.'s standing trees.
Exactly. And agricultural produce is the harvested produce of those biological assets.
So the logs, once they're cut down.
Precisely. The key word is harvested. They become produce at the point of harvest. And a common mistake was confusing this with organic. IAS 41 doesn't care if it's organic or not.
Okay, clear distinction. Living plant equals biological asset. Harvested product equals agricultural produce. So once harvested, how are those logs measured?
IAS 41 has a specific rule here. Agricultural produce is measured at fair value, less costs to sell, right at the point of harvest.
Fair value, less cost to sell, okay? What about the costs of actually harvesting them?
Good question. Those harvesting costs are not deducted from the fair value. They are expensed immediately. They go straight to profit or loss.
So fair value minus selling costs gives the initial carrying amount. Harvesting costs hit P&L.
Correct. And that's different from how we usually measure inventory under IAS 2, which is generally lower of cost and net realizable value.
Right. Another key difference to remember for agricultural businesses. Okay. Now shifting to the wood chips. Once the logs are processed, they become inventory, right? Governed by IAS 2.
That's right. They're no longer agricultural produce. They're inventory.
And the challenge here was about including overheads in the cost of closing inventory.
Yes. This tested the absorption costing principle. You have total production overheads, fixed and variable. You need to allocate a fair share of those overheads to the units that are still in inventory at the end of the period.
You can't just expense all the overheads.
No. The portion related to unsold inventory needs to be carried forward as part of the inventory cost on the balance sheet. The calculation involved figuring out the overhead cost per unit, or per bag in this case, and multiplying by the number of bags left.
And common errors were
forgetting to apportion altogether, or maybe getting the calculation wrong, or ignoring specific rounding instructions given in the question. Those little details matter.
They really add up. It's like building blocks, isn't it? Get one wrong,
and the whole structure can wobble.
Yeah. Okay. Quick one, permitted inventory valuation methods under IAS 2.
Easy one, hopefully. FIFO, first in, first out, and AVCO, weighted average cost, are allowed.
And the one that isn't?
LIFO, last in, first out, explicitly not permitted by IFRS.
Got it. FIFO and AVCO, okay. LIFO, not okay.
Now, the last bit for Timber Co. involved IAS 8, accounting policies, specifically a change in policy.
Right. They changed their inventory valuation method.
So what's the rule when a company changes an accounting policy? How does it hit the financial statements?
The fundamental principle in IAS 8 is that changes in accounting policy are applied retrospectively.
Retrospectively.
Meaning you have to go back and adjust the prior year's figures as if the new policy had always been used. You restate the comparative information.
Wow. Okay, so it's not just applying it from today onwards.
No, absolutely not. You have to adjust the opening balance of equity for the earliest prior period presented and adjust other comparative amounts. It's like rewriting the financial history to ensure consistency and comparability across years.
I can see why that would be tough. It involves adjusting opening inventory, which affects the prior year's closing inventory, which affects the prior year's profit. Exactly, it ripples backwards. In Timberco's case, it meant adjusting both opening and closing inventory figures, leading to a net impact on the current year's cost of sales. Many candidates struggled with that retrospective application.
Yeah, that makes sense. It requires careful tracking of the adjustments. Okay, we've covered foundations and case studies. Now for the big one. Section C, the constructed response questions. The deep end.
This is where application, analysis, and interpretation really come together.
And the examiner's key message here was about showing your work and using the scenario.
Absolutely crucial. You must show full workings for calculations, and you must integrate the specific details from the scenario into your analysis. Generic answers just don't cut it.
Let's look at Long & Co., the supermarket chain. The task was analysis and interpretation against sector averages. What were the main pitfalls?
Well, first, just calculating the ratios. Simple errors like using the wrong profit figure, say profit before tax instead of operating profit for the operating margin. Or not being clear what capital employed included for ROCE.
Return on capital employed, yeah.
Showing your workings clearly is vital. Even if your starting number is off, you can get marks for applying the formula correctly. The own figure rule.
Good tip. Then there was a tricky bit on convertible loan notes and gearing.
Always a popular topic. The main task was splitting the convertible debt into its debt and equity parts using IFRS 9 principles.
Okay, standard stuff. But there was a twist.
The twist was how the proceeds had already been recorded. The scenario said they'd been credited entirely to other reserves.
Ah, so you weren't doing the initial recognition entry.
Exactly. You needed a correcting journal entry to move the calculated debt portion out of other reserves and into financial liabilities. Many missed that context and just did the standard initial recognition debit cash, credit liability, equity split.
Ouch. Reading the detail is key. And that impacts the gearing calculation too.
Definitely. If you didn't make that correction, your debt figure for the gearing ratio would be wrong. Plus, common errors in calculating gearing itself using the wrong formula or definition.
So, calculation errors, misunderstanding the scenario. Then came the actual analysis. Comparing Long & to the sector.
And this is where many candidates really struggled, according to the report.
How so? Just stating numbers.
Pretty much. Just saying the gross profit margin increased or inventory days are higher than the sector earns 0 marks on its own.
You need the why.
You need the why, linked directly to the scenario. For example, the scenario said Long & was the largest supermarket. What does that imply?
Economies of scale, better buying power.
Exactly. So you should expect maybe a higher gross profit margin than the sector average. Or maybe they can push suppliers for longer payment terms, leading to a longer payables period. That's linking the scenario to the ratio.
Makes sense. What about inventory?
The scenario mentioned a new home furnishings agreement. That could explain why inventory days were higher. Home furnishings turnover is slower than groceries.
Ah, okay. So you state the ratio difference, link it to the scenario detail, and then explain the commercial logic.
Precisely. And you also need to avoid incorrect links.
Like,
well, some candidates linked new budget store openings to higher gross margins. Budget stores usually mean lower margins, higher volume. That's a misunderstanding.
right. Or getting IFRS 16 wrong again.
Yeah, thinking lease rentals still hit operating profit directly when under IFRS 16, without exemptions, it's depreciation and finance costs that impact profit, not the cash rental payment itself in the same way.
Lots of potential pitfalls, so good analysis is specific, linked, and commercially logical.
And finishes with a concise conclusion looking forward, maybe highlighting risks based on the analysis.
Okay, last big question area, stuipulutuko. Preparing consolidated financial statements, including a disposal. This sounds complex.
It is. Consolidation questions test everything. Precision is key.
And again, workings are vital.
Non-negotiable. Set up your pro forma statements straight away. Show every single working clearly. That's how you get method marks. The own figure rule applies massively here.
What were some of the fundamental consolidation hurdles people faced?
Okay, big ones. First, time apportionment. If a subsidiary is bought or sold mid-year, you absolutely must prorate its profit and loss items for the period it was actually part of the group.
So if bought April 1st, you take 912ths of its revenue, cost of sales, etc., for the year ended December 31st.
Exactly, for the consolidated P&L. Missing that is a basic fundamental error.
But not everything gets time apportioned.
Right. For example, a revaluation gain recognized in other comprehensive income, if it happened entirely post-acquisition, you'd typically include the whole gain attributable to the group, not time apportion it across the year.
Okay, another big error.
Proportionate consolidation. Some candidates still try to just take, say, 80% of the subsidiary's revenue if the parent owns 80%. That's wrong.
What's the right way?
You consolidate 100% of the subsidiary's assets, liabilities, income, and expenses line by line, and then you allocate the subsidiary's profit and comprehensive income between the parent, controlling interest, and the non-controlling interest, NCI.
Full consolidation first, then attribute to NCI. Got it. What about other adjustments? Fair value.
Yep. Fair value adjustments on acquisition often involves recognizing an intangible asset or uplifting property. That means extra amortization or depreciation in the consolidation, which also needs to be time apportioned if it relates to a mid-year acquisition.
Okay. And transactions between group companies, intra-group stuff.
Needs eliminating. Intra-group sales and purchases cancel out. Crucially, you also need to eliminate unrealized profit, URP, on inventory sold between group companies, but not yet sold outside the group.
The URP calculation? Tricky.
Can be. Need to get the markup or margin right and apply it only to the goods still held by the buying company at year-end. Also, intragroup dividends received by the parent from the subsidiary need to be eliminated from the parent's income and the group's perspective.
Right, because it's just moving money within the group envelope.
Exactly.
And Stupilotu also had an associate, Hard Horse Co. How does that work?
Associates use equity counting, not full consolidation. In the consolidated P&L or CSP/LOCI, you recognize the group share of the associate's profit for the period.
Also time apportioned if acquired mid-year?
Yes, absolutely. Only include the share of profit earned after the group acquired influence.
And financial liabilities, like loans.
Standard IFRS 9 amortized cost usually applies. Calculate the effective interest expense. And again, if the loan was taken out mid-year, time apportion the finance cost in the P&L.
So many details. Each adjustment really tests a specific consolidation principle.
It does. And one slip-up, like missing time apportionment, can have knock-on effects throughout the statements.
And just quickly, that associate, Hard Horse Co., how would the investment itself appear on the consolidated balance sheet?
Good question. Under equity accounting, the investment starts at cost. Then you add the group's share of the associate's post-acquisition profits, or deduct losses, and you subtract any dividends received from the associate. That gives you the carrying amount year by year.
Phew. What a deep dive that was. It really hammers home how understanding these common problem areas in financial reporting can seriously sharpen your own skills.
It really does. It's not just about passing an exam. It's about truly understanding what the numbers are saying.
Yeah, moving beyond just compliance to actual interpretation.
Exactly. Financial statements tell a story, right? About the company's health, its strategy, its performance. Knowing the standards, knowing the potential pitfalls helps you read that story much more critically, much more accurately.
And make better decisions based on it.
Whether you're investing, managing, lending, whatever your role, that deeper understanding is invaluable.
So knowing where others often struggle, it doesn't just highlight knowledge gaps, does it? It sort of points towards where the real financial insight actually lies.
Well put. It shows you where to focus your attention for deeper understanding.
So maybe a final thought for you, the listener. What part of these detailed insights, the optionality in leases, the NCI's share, the retrospective changes, the consolidation adjustments, what part will you dive into next to really master your understanding of financial reporting?